You wake up in the morning, and without thinking, you participate in one of the most complex economic systems ever created. You check your phone. You order coffee through an app. You tap a card or a screen or a watch. $6 disappears, and nothing physical moves. No bills change hands. No coins are counted. No object representing value travels from you to the seller. What actually happens is quieter and far more revealing. A database subtracts a number. Another database adds a number. Two institutions acknowledge each other's records, and the transaction is considered complete. Now pause for a moment, because in that pause lies the single most important difference between the economy you live in and the economy that shaped every generation before you. Nothing you just used is money in the traditional sense. It is trust, encoded, abstracted, and enforced by systems so large you never see them. And that difference explains nearly everything you feel today. Why prices rise faster than wages. Why saving feels pointless. Why debt feels unavoidable. Why your grandparents built wealth doing things that no longer work. If you feel that something about the economy doesn't make sense anymore, you're not wrong. You are simply living inside a system built on rules you were never taught. And in the next few minutes, you're going to see those rules clearly. But first, let's do something unsettling. Let's rewind time. Imagine the same morning, but 2 centuries ago. You wake up. You walk into a small coffee house. You order a drink. And when it's time to pay, you reach into your pocket and remove a silver coin. Not a symbol, not a promise, not a claim on value. Value itself. The coin has weight. It has purity. It has intrinsic worth. The merchant takes it, examines it, maybe even bites it, not out of habit, but out of verification. The transaction is complete only when physical metal changes hands. No trust in institutions is required. No belief in future promises is necessary. If the government vanished tomorrow, that coin would still buy something, because silver has use beyond permission. That single contrast between numbers in a database and metal in a hand defines the difference between the old economy and the modern one. And once you truly understand that difference, the confusion disappears. The anxiety makes sense. The frustration becomes logical. The system reveals itself. This is not nostalgia. This is structural literacy. For thousands of years, economies were constrained by reality. Money had to be something. It had to exist. It had to be scarce. Gold, silver, land, grain. These were not symbols. They were limits. If a ruler wanted to spend more, he needed more metal. If a society wanted to grow, it needed more production. Growth was slow. Inequality existed. Life was harder. But the rules were visible. And most importantly, money was a store of value. A silver coin bought roughly the same amount of food across generations, not year to year, but century to century. This stability was not accidental. It was enforced by physics. You cannot print gold. You cannot conjure silver. You must mine it, refine it, and transport it. Reality imposed discipline. And then, gradually, that discipline was removed. Not overnight, not by conspiracy, but by necessity. The first cracks appeared when governments discovered that wars were too expensive for honest money. In the early 20th century, global conflict demanded spending beyond physical reserves. Gold standards were suspended temporarily. Paper promises replaced metal backing. What began as emergency measures became precedent, and precedent becomes policy. By the mid-20th century, the world ran on an uneasy compromise. Paper money tied loosely to gold, mediated by governments and central banks. This system held, barely, until 1971. That year marked a clean break from everything that came before. When the United States ended gold convertibility, money ceased to be constrained by substance. For the first time in history, the global reserve currency was backed by nothing but trust. No metal, no physical limit, only belief. From that moment forward, the economy stopped being a system of value exchange and became a system of credit expansion. This is where most explanations stop, but this is where understanding must begin. Because fiat currency alone does not explain the world you live in. The deeper transformation happened inside banks. In the modern system, money is not created by governments printing bills. It is created when banks issue loans. When you take out a mortgage, the bank does not give you money it already has. It creates new money. Numbers appear where nothing existed before. And that money enters circulation as debt. This means something profoundly important. Almost every dollar in existence is owed to someone. And interest ensures that more dollars are owed than exist. The system survives only if credit keeps expanding. If lending slows, money disappears. If money disappears, spending collapses. If spending collapses, the economy breaks. This is why growth is no longer optional. It is mandatory. And this single requirement reshaped society. Saving, once virtuous, became harmful to growth. Consumption, once restrained, became patriotic. Debt, once feared, became necessary. The modern economy does not reward prudence. It rewards participation. And those who understand this early position themselves differently than those who don't. This explains the widening gap you see everywhere. Those who own assets benefit from inflation. Those who earn wages are eroded by it. Those closest to credit creation receive new money first. Those furthest receive it last, after prices have risen. This is not theory. This is structure. And once you see the structure, you stop blaming yourself. You realize you are not failing at the economy. You are navigating a different one than you were taught to expect. In the next part, we will go deeper. We will examine how debt replaced savings, how consumption replaced production, how central banks became the hidden architects of daily life, and why the system now depends on fragility to survive. Not to scare you, but to make you fluent. Because fluency is the difference between being used by a system and using it intelligently. To understand why the modern economy feels unstable, you have to unlearn one deeply comforting idea. The idea that money is neutral. It isn't. Money is not a passive tool that simply measures value. It is an active force that shapes behavior, incentives, and power. And when the nature of money changes, everything built on top of it changes too. Quietly, relentlessly, and often invisibly. The economy your grandparents navigated was constrained by scarcity. The economy you inhabit is constrained by confidence. That difference is everything. In the old system, growth followed production. You made something real, you earned something real, and you saved something real. In the modern system, growth follows credit. Something is promised, something is leveraged, and something is spent, often before it exists. This reversal transformed the role of banks from intermediaries into creators. Historically, banks connected savers to borrowers. They allocated existing capital. Today, they manufacture purchasing power. When a bank approves a loan, it does not transfer pre-existing money. It expands the money supply. This is not opinion. It is how the system is designed. The implication is staggering. Money no longer enters the economy as earned value. It enters as obligation. Every dollar is born owing something back. This is why debt is no longer an anomaly. It is the foundation, and foundations shape architecture. Once debt became the engine of growth, the system required constant expansion to remain stable. Not growth for prosperity, growth for survival. This is why recessions feel more violent now. In a credit-based system, contraction is existential. When loans are paid down faster than new ones are issued, money vanishes, spending slows, businesses fail, employment collapses. So the system intervenes. Interest rates are lowered, liquidity is injected, risk is encouraged. Not because excess is desired, but because stagnation is intolerable. Central banks did not become powerful because they sought control. They became powerful because the system cannot function without them. Once money lost its physical anchor, someone had to manage confidence. That someone became the central bank. Interest rates are no longer just prices of money. They are behavioral signals. Low rates tell you to borrow, spend, and invest. High rates tell you to pause, protect, and retrench. But here's the problem. You cannot lower rates indefinitely, and you cannot remove debt without destroying the money supply. This is the trap. The modern economy is not broken. It is cornered. Every intervention solves the last crisis by creating the conditions for the next one. This is why each cycle feels larger. More debt, more stimulus, more fragility. The 2008 financial crisis was not an accident. It was a structural stress test. Too much leverage, too little redundancy, and a belief that asset prices could only rise. When it collapsed, the system chose preservation over purification. Bad debts were absorbed. Losses were socialized. Liquidity flooded the system. The immediate collapse was avoided, but the underlying dynamics intensified. Debt increased, rates fell further, asset prices inflated, and inequality widened. Because money does not enter the system evenly, those closest to credit creation receive it first. Banks, corporations, financial markets. They buy assets before prices rise. Those further away receive it later, through wages, services, and fixed incomes. They face higher costs before higher pay. This phenomenon is not ideological. It is mechanical. And it explains why the economy feels increasingly disconnected from lived experience. Markets soar. Costs climb. Stability erodes. You are told the economy is strong, yet your purchasing power shrinks. This is not contradiction. It is perspective. The system measures health differently than individuals experience it. To the system, growth is success. To individuals, security is success. And those two goals are no longer aligned. This is why saving no longer feels rewarded. In a system that requires spending to survive, saving becomes a drag. Cash loses value over time. Assets inflate. Risk-taking is incentivized. You are subtly pushed to participate, to invest, to borrow, to consume. Not because it's good for you, but because it's good for continuity. This creates a psychological tension that previous generations did not face. They were told to be patient. You are told to be aggressive. They were taught restraint. You are taught optimization. And when restraint fails, you blame yourself. But the rules changed, and no one explained them. This brings us to an uncomfortable truth. The modern economy does not punish recklessness. It punishes immobility. Those who stand still are eroded. Those who engage are elevated, at least temporarily. This is why financial literacy today is not about thrift. It is about navigation. Understanding where money flows. Understanding who receives it first. Understanding how policy reshapes incentives. This does not make the system immoral. It makes it directional. And direction matters. In the next part, we will examine how this system reshaped labor, productivity, and time itself. Why working harder feels less rewarding. Why stability feels further away. And how the economy quietly transferred risk from institutions to individuals. Not to discourage you, but to give you the clarity that most people never receive. Once money became abstract, risk did something subtle. It didn't disappear. It moved. In earlier economic systems, risk was concentrated at the top. Landowners bore harvest failures. Merchants bore trade losses. Banks bore credit mistakes. Failure was painful, but localized. In the modern economy, risk was redistributed downward, quietly, systematically, almost politely, and most people never noticed it happening. To see this clearly, we need to look at what happened to work. For most of the 20th century, work was tied to stability, not wealth, but predictability. You traded time for wages. Wages bought a life. A career implied continuity. This arrangement made sense in a system where money held value and growth followed production. But once money became elastic, labor had to adapt. Because fixed wages and flexible money are incompatible. If the money supply expands faster than wages, purchasing power erodes. If purchasing power erodes, security disappears. The solution was not to raise wages indefinitely. The solution was to financialize life. Pensions became investments. Healthcare became insurance. Education became debt. Housing became speculation. Risk that once lived on institutional balance sheets was transferred to individuals. Your retirement now depends on markets. Your health depends on actuarial tables. Your education depends on leverage. Your shelter depends on asset inflation. None of this was sold as risk transfer. It was sold as opportunity, choice, flexibility, ownership. And in isolation, each step seemed reasonable. Together, they rewired society. Work no longer guarantees stability. It guarantees exposure. Exposure to inflation. Exposure to volatility. Exposure to cycles you do not control. This is why working harder feels less effective. Productivity has risen dramatically over the last half-century. People produce more per hour than ever before, yet real wages have stagnated. This is not because effort declined. It's because value capture changed. When money is created through credit, those closest to credit capture the upside. Labor, paid last, absorbs the downside. This is why asset owners feel insulated while workers feel squeezed. It is not cultural, it is structural. Time itself has been redefined. In older systems, time was allied with patience, save now, benefit later. In the modern system, time is adversarial. Cash held today loses value tomorrow. Debt incurred today demands more tomorrow. Delay is punished. You are incentivized to act now, to buy, to invest, to optimize. This creates a constant psychological pressure, not fear, urgency. Urgency is more productive. It keeps the system moving, but it exhausts individuals. This is why burnout is not a personal failure. It is a systemic outcome. A system that requires perpetual motion cannot allow rest. Now consider inflation, not as a number, but as a process. Inflation is not simply rising prices. It is the dilution of purchasing power. And dilution is not neutral. Those with fixed incomes lose. Those with flexible assets adjust. Those with debt often benefit. This flips traditional morality on its head. Borrowers are rewarded. Savers are punished. This is not ideological bias. It is arithmetic, and it reshapes behavior across generations. Why delay gratification if money decays? Why avoid debt if inflation erodes it? Why trust stability if volatility rewards action? These are not irrational questions. They are rational responses to incentive structures. The tragedy is that most people answer them unconsciously. They feel the pressure, but don't understand the source. So they internalize it. They assume they are failing. They assume they are behind. They assume the economy is something they simply don't get. But the truth is simpler and more unsettling. The economy they were prepared for no longer exists. They are operating in a system optimized for velocity, not well-being. This is not accidental. A credit-based economy must keep money circulating. Stagnant money is dangerous. Savings slow velocity. Velocity sustains growth. So behavior is nudged accordingly. Spending is encouraged. Risk is normalized. Stability is deferred. The result is a society that feels permanently provisional, always adapting, never arriving. This brings us to the final shift: trust. In older systems, trust was interpersonal and local. You trusted your bank because you knew the banker. You trusted your money because you held it. You trusted the future because change was slow. In the modern system, trust is institutional and abstract. You trust systems you cannot see. You trust policies you do not vote on. You trust models you do not understand. This works until it doesn't. When trust weakens, the system cannot rely on coercion. It must restore confidence. This is why narratives matter, why optimism is promoted, why stability is emphasized, why doubt is framed as irresponsibility. Confidence is not merely emotional, it is structural. Without it, the system seizes. Understanding this does not make you cynical. It makes you literate. Literacy allows choice. You cannot opt out of the system, but you can navigate it consciously. You can distinguish signal from noise. You can see incentives clearly. You can align your behavior with reality instead of expectation. In the final part, we will bring everything together. We will examine what this system requires going forward, what limits it is approaching, and how intelligent individuals respond, not with panic or rebellion, but with clarity and strategic calm. Every economic system eventually reveals what it values most, not through speeches, not through textbooks, but through what it protects when stressed. The modern economy is no exception. When faced with crisis, it does not protect savings. It does not protect purchasing power. It does not protect long-term stability for individuals. It protects continuity. Continuity of credit. Continuity of markets. Continuity of confidence. And once you understand that, the seemingly irrational decisions of the past decades begin to make sense. Bailouts, stimulus, quantitative easing, permanent intervention. These were not mistakes. They were consistent responses within a system that cannot tolerate contraction. A credit-based economy cannot allow widespread deleveraging, because deleveraging destroys money. And destroying money destroys demand. And destroying demand collapses the system. So when stress appears, the response is always the same. More liquidity, lower rates, expanded balance sheets. This is not corruption. It is necessity. But necessity has consequences. Each intervention pushes risk forward in time. Each rescue increases dependency. Each solution narrows future options. This is why the system feels increasingly fragile, not because it is weak, but because it is fully extended. The margin for error has thinned. In earlier eras, recessions reset excess. They cleared bad investments. They punished misallocation. Today, recessions are treated as threats to be neutralized. This preserves surface stability, but deepens imbalance. Debt accumulates. Asset prices inflate. Inequality widens. And individuals are left navigating a system that no longer rewards patience, caution, or long-term thinking. This creates a quiet, psychological toll. People feel pressured to act constantly, to optimize endlessly, to compete not just with others, but with time itself. This is why anxiety feels systemic, because it is. A system that cannot slow down transmits that urgency to everyone inside it. Now here is the crucial insight. The modern economy does not collapse from one dramatic failure. It erodes through misalignment between incentives and well-being, between growth and meaning, between abstraction and lived reality. This erosion does not produce headlines. It produces fatigue. And fatigue is dangerous, not because people revolt, but because they disengage. A system built on confidence cannot survive widespread disengagement. This is the paradox policymakers now face. They must maintain belief while managing limits. They must promise stability while increasing intervention. They must encourage trust while quietly rewriting rules. This is why transparency is partial, why explanations feel unsatisfying, why official narratives lag lived experience. Not because leaders are malicious, but because honesty about limits threatens confidence, and confidence is the load-bearing wall of the system. So where does this leave the individual? Not powerless, but differently empowered. The goal is not to escape the economy. That is fantasy. The goal is to understand it well enough to stop fighting it blindly. Understanding changes posture. You stop expecting fairness from mechanisms designed for continuity. You stop measuring success by outdated benchmarks. You stop internalizing systemic pressure as personal failure. Instead, you begin to think in systems. You recognize that inflation is not a temporary anomaly, that volatility is not an accident, that intervention is not exceptional. They are features of a structure built on elasticity. This understanding does not make you cynical. It makes you strategic. You become selective about risk, intentional about leverage, patient where patience still works, flexible where rigidity is punished. You stop asking when things will go back to normal, because this is normal now. A system sustained by confidence, motion, and managed fragility. And here is the final, often missed, truth. Despite its distortions, the modern economy is not a villain. It is an adaptation, an attempt to sustain complexity at scale. It allows billions of people to coordinate without knowing each other. It enables innovation at speeds unimaginable a century ago. It absorbs shocks that would have shattered older systems. Its cost is not collapse. Its cost is tension. Tension between speed and stability, between growth and satisfaction, between abstraction and meaning. Navigating that tension is the defining challenge of modern life. Not winning the economy, not beating the system, but understanding it deeply enough to move through it without losing yourself. If you've stayed with this analysis to the end, it's because you sensed that something didn't add up, and you wanted more than slogans or surface explanations. That instinct matters. Because systems like this don't require blind belief. They require informed participation. If this perspective helped you see the structure more clearly, not with fear, not with anger, but with clarity, you can support work like this thoughtfully. Subscribing helps sustain long-form analysis in a short-form world. A like signals that depth still has value. And if there's one person you trust enough to think with, not argue with, not impress, but genuinely reflect with, consider sharing this with them. Ideas like these are not meant to spread through outrage. They spread through quiet recognition. And if you leave a comment, let it be one that adds to understanding. A question, a reflection, or a carefully reasoned challenge. That is the kind of conversation this subject deserves. Thank you for watching all the way through.